Hey traders, welcome to our weekly report. I'm Raghee and this is my report. I'm glad y'all could be here. And we are going to take a look at what's the game plan for the week, what's on the economic calendar as we look at this week. And of course, as we go into the end of October, often a very feared month, where are we in terms of the trend? Where are we in terms of the target rate probabilities? Because that is going to be the easiest route to understanding the Federal Reserve's messaging. Oh, just forgot to turn the light back on. Gosh, that's a lot. Right. There we go. All right. Technology. All right. So let's get to it, shall we? We got a lot to cover, and we got 30 minutes to do it. As always, thanks for making time out in your day to join us. All right, let's kick it off with the economic calendar. Here we go. Forex Factory, forexfactory.com. Click on the calendar, and this is a great place to start quite frankly, every single day. I recommend starting off the week because the market does look ahead. The market does consider if we have an important event on Tuesday, but say options expiration on Friday, or we have an important data release on a Monday, but we've got a Fed Wednesday. Remember, things are prioritized. There is a prioritization. There's a hierarchy of the news. It's not chronological. There is a sort of hierarchy. So keep that in mind. And that the other thing we want to remember, if we're going to have the ability to use these as catalysts, write it down, put it in your journal, know what time, know what the expectation is, know what the potential impact could be could be volatility, which is my preference. So those are things we can do, and we can only prepare for them in advance, right? We don't want to get blindsided on a Monday by a flash services PMI at 9:45, quirky time. It's an easy to overlook type of hot zone. Then at 11 a.m., we have Treasury Secretary Yellen, not something we have on the calendar on a regular basis. But at 11 a.m., you better believe that anyone, Yellen, Powell, the FOMC members, voting and non-voting, are going to have that kind of impact. And then Tuesday, consumer confidence numbers. Waller speaking at 1:55. Know the time. So make sure you check that out. And then the other calendar during this season, it's earnings season, is making sure, and I like to use Estimize, making sure we know when the heavily weighted stocks within the indices and the heavily weighted stocks within those important sectors are coming out. Because those stocks, because of their weighting, because of that disproportionate weighting that the indices and most of the important sectors are organized by, in other words, a very small number of stocks can move the markets in a huge way. We've got to know those earnings. Those are hot zones of another type, but in their own right, market movers during this season. All right, so let's also take a quick look at where we are to kick off this Sunday open. Who's open right now? By the way, why 6 p.m. on a Sunday? Remember that futures and Forex, those are a little bit more 24-hour-esque markets. And Forex has 24-hour session, 5.5 days, right? Not all of us here are Forex traders, but I want you thinking about a little bit of the globe and the futures similarity to Forex in that a lot of these futures contracts trade far more than 9:30 to 4 p.m. Eastern. And this is a look at the opening sentiment. And usually there's a saying, don't fade Fridays. We're going to see some of that follow through from Sunday to Friday. And that's a little bit of what we're seeing here as well. In terms of target rate probabilities, I'm sure there'll be some questions on it, and we will jump into that. We'll go into that FedWatch tool and talk about where we are in terms of the end of the year, as well as what does May look like? When are we going to peak and plateau in the target rate probability? And why does this matter? Okay, what is our problem right now? What's the big overarching problem that none of us can trade around? When is the Federal Reserve going to be done? When are they going to stop hiking? When are they going to signal they're going to stop hiking? And at that point, we can get an idea of what mortgage rates, for the most part, are going to be. We can get an idea of what lending rates are going to be. And we can start to just get our sea legs back in terms of the tightening cycle and where we're going to stop, and where the economy and companies and individuals can say, all right, we know what rates are going to be. That level of uncertainty is huge. And once that level of uncertainty is gone, I'm not saying we're up and away in terms of equities, although a lot of you know I'm not a super bear. Never was. Never succumbed to that conversation throughout the year. I'm not saying it's good. I'm not saying it's bad. I'm just saying I'm just not a super bear. It doesn't mean I'm bullish either, but I'm open to what can happen next. I don't have a target hundreds of points below where we are right now. I don't have a target hundreds of points above. I'm in the now, right? And I think that's the best place for all of us to be. And in the now, by the way, is where the volume happens. Think about what volume is. It's volume participating now. It's my opinion of where the market is, and all of ours, really, right? Now. And I think that's where a lot of us can find an edge in markets like this, when we know that we're never going to be alone in a trade, right? So let's kick it off. Speaking of never alone, I know we always have a ton of great questions. So let's kick it off here. All right, JP, how are you? Can I review Starbucks? Sure. On the weekly? Absolutely. Absolutely. All right, Starbucks on the weekly. It bottomed between April and June. Let's open this up. And is now fighting with the weekly 200, right? Now, the dots I have on my weekly are the 200 exponential. That's my preference. A little bit of recency bias built into that 200 exponential as opposed to simple. Look at them both. They're both valid and valuable, and usually in a similar neighborhood to one another. It did not participate in the recent market pullback. So when we talk about the market, right, I think we've talked about this before, and JP, awesome question. We can talk about the market in terms of the S&P, NASDAQ, Dow. I think when all of us talk about the market, we're talking about stonks, right? We're talking about the equity indices, S&P, NASDAQ, Dow. Some folks might include the Russell. I do not. The three major averages are S&P, NASDAQ, Dow. And then we ask ourselves, where is Starbucks in the mix? Because in the Dow, Starbucks really doesn't matter. We know this, yes? And if you didn't, now you do. Where is Starbucks more heavily weighted? Well, Starbucks is in the XLY. That's your consumer discretionary. Consumer discretionary is actually quite heavily weighted in the NASDAQ. So I'm not saying that Starbucks is a tech stock, but I think a lot of times it's easy to overlook that Starbucks is a big part of a sector that's a big part of the NASDAQ index. So when we talk about not participating, that's who I'm going to compare it to, right? JP, that's who I'm going to compare it to. And relative to the NAS, I'm with you. It really hasn't been as weak. So then I ask myself, well, what's the XLY been up to? So could Starbucks be a relative outperformer in relation to the NAS and the XLY? And I agree with you. I agree with you. It is a relative outperformer, meaning if the markets sell off, markets meaning in this case, NASDAQ and consumer discretionary, right? We want to define what the markets mean. So when NASDAQ and consumer discretionary, if they were to sell off, could Starbucks be a little bit more resilient? My answer would be yes. Now here's where it gets exciting. If Starbucks were to benefit from a NASDAQ rising tide, or could Starbucks benefit from a NASDAQ rising tide and a consumer discretionary rising tide? Absolutely. Absolutely. In fact, if Starbucks wants to run and those two getting out of its way essentially would clear the path, it's a really good relative outperformer. Yeah. JP, great question. Hey there, Mark. TLT looks like an exhaustion gap down, which can reverse upward. What are my thoughts? Hey, Mark, my thought is I'm going to start with not TLT, because remember, TLT is the 9:30 to 4 o'clock version of the futures, which kind of going back to that more 24-hour mindset. The ZB, the long bond futures, is your more, I'm going to use, I don't want to say right and wrong. It's the more complete look, right, at what bonds are telling us about yields. This case, we're looking at the long bond. So that would be the ZB contract. And in terms of gaps, because TLT just sort of starts trading at 9:30, there'll be holes on that TLT chart that don't necessarily exist on the ZB, because the ZB's been trading. So I will only look at gaps if they're visible on the futures contract. The gap on ZB would be far more important to me than a gap on TLT, the ETF alternative. However, here's how we can ask ourselves, all right, Rog, so are you saying that a TLT gap is not important? No, what I'm saying is it needs to prove itself, that it's important a little bit more. And the way that we do that is with volume. If that gap open and close, and in this case with TLT, if I were to look at the gap situation here and some of the volume accompanying it, and we zoom in a little bit more, okay, 93.5, 96.5, 95.70, those are levels to watch. Are they going to coincide with opens and closes and highs and lows? Probably. And when they do, it's even easier to use that information when it comes to a gap, right? So ZB gaps, the futures gaps are going to be more important to me than the TLT gap. But if there's a hole on the chart, which is all that a gap is, right? There's a hole in the chart, we're going to want to use volume. We're going to want to use that attention, that intensity, that participation. It's one thing for folks to say, well, this is what we think is going to happen. And talking heads saying, well, this price is important. I don't care what people say, right? What's that old saying? I don't care what you say. I care what you do. I look to more how you act more than how you talk, right? That's the volume. Volume is the acting. Volume is what are you doing as opposed to what are you saying? And that's how I would use that there, Mark. Good stuff. All right, Sam, how are you? I did have a couple of really great days off. We're going into sort of a busy season, and I thought I really wanted to be super recharged. It was a little bit of a work weekend, sort of, because it was in preparation for some things coming up over the next few weeks and really next couple of months. So thank you. And yeah, we're going into a pretty busy season. I think some of you probably already know. Maybe you got the email on Tuesday. I've got a webinar, and if you haven't already got the email, let me give you the super secret link. If you didn't get the email already, so you'll have it first. simplertrading.com/key. It's day after tomorrow, gang. So we're going to be together on Tuesday, talking a lot about, well, actually, we're going to be talking all about volume. What are the similarities in this market? And I don't mean about all the, oh, this looks like 2001, and oh, this looks like 2008, and whatever. This looks like 1920, whatever seems to be floating around out there. What are the similarities in the tradability of this market? Where are the similarities in the things that we can say, oh, this happened in 08, and this is how I took advantage of it, or this is what happened in 2020, even 2019, and this is how I took advantage of it. Oh gosh, this is what happened just in July of this year, and this is how I took advantage. So I'm not talking about where the market could go. I'm talking about what can we do right now to trade this market. So I'm really stoked about that. And I not only, well, I'll tell you, Sam, I was actually at a cool workshop with my little sister. So we did a workshop together, and I'm not one to do nothing, because even when I'm not with you all, I'm still thinking of you all. What's the next thing we're going to do, and how can we trade this market together better? All right, I am Groot. Thanks, Sam. It's great to be back, though. It's great to be back. I miss you all when I'm not here, for sure. I miss trading for sure when I take a couple of days off. But options expiration's a day that I look at as a caution day anyway, so it worked out really well. All right, next up, I am Groot. How are you? MU bullish on the daily. Bullish momentum, my friend. Let me get my drawing tools out here. Okay. Where do they go? There they are. So bullish on the candle and on the momentum. Agreed. Yes, agreed. But bullish in terms of trend, not quite yet. So I agree, but there's not much I can do with this yet. Maybe intraday, maybe day trading some options, maybe even at this price, day trading some shares, but not yet for me as a trend follow, but definitely worth keeping an eye on because we're starting to see, look, what's the building block of a trend? A trend never gets started without sentiment shifting in the direction of that eventual trend and then momentum following suit. So people start thinking bullishly, they start acting bullishly, and if momentum persists, we have a trend. So that's a good thing to keep an eye on for sure. Yes. Follow-up question is the euro. Is it a short on the daily? It's not a downtrending short in the way that I believe still the pound is, and even the yen. No, the pound's kind of gotten choppy out of the downtrend, and the yen, last I looked, was still in a downtrend, but let's double check if it regained that red trend or not. So the best short amongst the three currencies that are most heavily weighted within the dollar basket, the US dollar index basket, in order, euro, yen, pound. The one that's most shortable amongst those three most heavily weighted currencies is the yen. I would say the pound and the euro would follow sort of a distant second in terms of shorts, but it would be agreed. It would be a short. I don't have the same expectation for the dollar to continue to climb in that very strong way that it did earlier this year when we were beginning that journey into the tightening cycle from the Federal Reserve. I don't expect that. But as long as euro and pound and yen, or I should say euro, yen, and pound remain weak, it's impossible for the US dollar to weaken. The only way that all four currencies could be weak is if they're sort of on a race to the bottom, but there's always going to be a relative outperformer amongst them. So it's literally impossible to say that I want to be short all four. One of them's going to say, hey, this is the support in the dollar while this is the resistance in the euro. And that's where your euro short bias. Yes. Is it a crowded trade? And I think if we were to sort of translate what crowded means, group, and I'm here, I'm with you. Is it a vulnerable trade to a shift? Crowded meaning how much more could it go? Crowded to me happens if I'm shorting at the low, or as they say, shorting in the hole. Crowded to me is oftentimes if we're buying at a new high, kind of buying in the blue sky. So as long as I'm not shorting in the hole or buying in blue sky, I'm not as concerned about crowded. But let's flip that around and say, what's the easiest way to manage risk? Let's short resistance, not a break of support. And in that way, and this is what I teach everyone in the Sector Secrets Mastery, and in that way, we don't need the market to make a new high if we're long or make a new low if we're short. Just retrace the steps that you're willing, or a portion of that you're already willing to do, covering the well-covered path, the well-worn path already. So good stuff. Thank you. Did we get a Fed pivot with the dovish comments from Daly? I don't believe Daly can move the market. Group, I think that there's a chance, more so than ever, that the sentiment around what the Federal Reserve is going to do has gotten the pendulum swung so far, we've factored in so much hawkishness from them. We're at that point where it's easier to have a bit of a sigh of relief rally if they don't sound even more hawkish than, say, taking us through 5 to 5.25% on the target rate probability. So the only way, and I do mean the only, I'm not saying that, well, I don't say this often. This is the only way. If you want to know, did Daly move the market in a significant way? Look at December. Are we going to end this year in a place that exceeds what we already have anticipated? And then the next and separate but related step is, where do we peak and plateau? What's the highest target rate probability it seems that we're going to reach? It looks like 5 to 5.25, maybe 5.25 to 5.5. And then things start to simmer down come May of next year, because as we go into June, we're not looking at higher target rate probabilities anymore. We're looking at lower target rate probabilities. So when people say, Rob, could we start preparing for cuts mid next year? I'm not going to guess. I'm not going to talk about secret squiggles and my crystal ball. And no, I'm going to look at the target rate probability. And this comes from a futures contract called the Fed Fund Futures. So there are trades and opinions that are saying this is what we expect. People are putting their money and their volume, right? People are putting their money where their mouth is and making a bet on this. That's the kind of opinion that I like to follow. And that's the way I'm going to measure that. So thanks for the question. Good stuff. All right. Next up is, and by the way, for those of you that maybe just be joining in, if you haven't already got the email, webinar this Tuesday, 8 p.m. Eastern, 7 Central, simplertrading.com/key. How am I trading right now? We're going to really, what's cool about this, and I'm trying to remember what the second date is, because the way that I like to break down the webinars is I want to show everyone how things work, both intraday and end of day. So this is really going to be an interesting discussion that we're going to have starting Tuesday and going into next week. So super excited about that. You'll definitely want to register, at least see what I'm doing. And if nothing else, you'll have some actionable ideas going into the very next day to say, all right, I'm going to look at the markets a little bit differently. So the first one is October 25. And the second one is, oh, wait, you know what? The bot just told me. November 2. All right. So moving on to our next question. Perfect Gulf weather north of Florida. Can you help me understand the price movement of 6B and FXC? So we talked about 6B already a little bit, Mr. Walker. It's that relationship back to the US dollar, and in a lot of ways when it comes to 6B right now, Mr. Walker, we know the UK politically, fiscally, monetarily is just in a state of absolute flux. It is in a state of absolute confusion. So I would say be very careful about 6B right now, but it has that inverse relationship to the dollar. But Freeport-McMoRan, yeah, FCX, Freeport, oh no, FCX, right? Freeport-McMoRan, this one I would look at closely with copper. Copper and Freeport-McMoRan moving together is very powerful. In fact, except for around earnings, Freeport-McMoRan has such a good, reliable, positive correlation. In other words, if copper moves a certain way, so will Freeport-McMoRan. And they tend to move that way very well, except for when we go into earnings season and then there's a disconnect. So now that we've got earnings behind us, watch copper. That's the best way to understand Freeport-McMoRan. Yes. Okay. All right. Next up is, and by the way, there's some jerk who's a fake Raghee. I'm going to block this right now. I am not going to pimp Bitcoin in my show. What the heck? Fake Raghee. All right. Yeah, ignore that, please. We are awarding nonsense. We're going to rip you off is what that fake Raghee is saying. All right, people. Mark, interested in my thoughts on Euro US and Pound US. So same thing, Mark. Inverse relationship to the US dollar. I'd rather short Euro US. I'd rather short 6E. I'd rather short the FXE. Same thing with Pound. I'd rather be short. Now, this is where it does get confusing. So now that everyone knows, I'd rather follow the path of least resistance, which is up in the dollar and down in euro, yen, and pound. Mostly yen, by the way, gang. If you want a better trend, here's why you're going to like the yen better. US dollar versus Japanese yen futures, or the FXY. Here's why you're going to like it better. Let's say we start seeing a weaker dollar. because there's expectation that the Federal Reserve is found the peak on target rate probability. They're not going to remain as hawkish. Remember, a hawkish central bank, any central bank that's hawkish, that's bullish. I know all these animals, right? Hawks and bulls. This is why this works for currencies. If a central bank is favoring higher rates, that's hawkish. And that makes the currency stronger. That's bullish. However, let's say the dollar starts to move lower because we think the hawkish peak has been found with the US central bank. The euro could start to strengthen. So could the pound. However, if we as traders and investors think that the Federal Reserve is done and we're willing to start to slowly buy stocks, strength in equities does tend to have, it's the carry trade conversation, a weakening impact on yen because it's a carry currency, it's a carry trade. So yen could continue to be weaker against the US dollar. And even if the dollar's weak, as long as the other currency is weaker, that trend can remain intact. So it's always a foot race in many, many ways, okay? And then that's where I would say favor the yen, all right? Wow, we really have the spam jerks out. Oh my gosh. Look at this. So one spam, I don't know if y'all see this. It might be on my YouTube channel or my Facebook. Oh, it looks like it's on my Facebook channel. So the spammers are on Facebook. So if you're watching me on Facebook right now, the fake Raghee is talking to some other jerk. Look at this. The fake Raghee is having a conversation with somebody else. The internet is so fascinating. So fascinating. All these very troubled people. Gosh. Just want to give them a hug. No, not really. Not really. All right. Can we take a look at the S&P? All right. We take a look at the S&P. Absolutely. I'm going to continue to recommend that traders focus on the short-term time frame on the S&P. I'm also going to continue to recommend that traders do not get overly bearish as we test lows. I hope, look, gang, I'm not trying to be a contrarian. I'm not trying to pick a bottom. I'm using volume, gang. And if you've been following the free videos, and if you haven't been, you'll get a crash course on why I got long in July and why I pretty much sort of begged folks not to get short when we started breaking down through lows, because guess what we did not do? We did not have volume participation. The day that we shot up off those brand new lows, we actually had more volume on that up day than the average amount of volume we had in October. Gang, the volume's been telling us, don't do it. Don't do it. And that's what's so important here. This is what I saw back in June, July. That's what got me long. That's what I saw. Gang, where all this started for me, this understanding that I cannot be alone in my trade idea if I want to be a winner, right? And that was, you've got to take advantage of the volume. And in that regard, this started in 08, and it just keeps working because it's a pattern in volume that leads to all the other patterns and all of our other indicators just working better, right? And if nothing else, it prevents you from really bad trades like, hey, let's short on the 30th of September, or hey, let's short on new lows on October 13. Retail traders are my people. We all are, I'm imagining mostly. There might be a few folks that aren't, but I'm a retail trader, gang. This is my home office. You're in with me right now. And I want you to understand the same thing I learned, which is I cannot be alone in my trade idea. And price without volume is absolutely incomplete, because did one share go off there? Did 101,000 shares go off there? You know that size matters in this regard. All right, moving on. Oh my gosh, even more spammers. All right, if you're on my Facebook, you're just giggling your butt off on these fake little spammers. Wow. Your mothers must be so proud. Okay. I look at that. Oh my gosh. Yeah, but I know you're on YouTube. So I have my Facebook channel with our show, my YouTube channel, and of course, the Simpler Trading. I might have to stop the Facebook. That's ridiculous. Wow. Okay, moving on. In terms of, Gang, and I'm going to leave you with this because we're just about out of time. And I think this is a really interesting look at the data. Yes, the Federal Reserve continues to hike rates. I do, based on previous cycles that I've been through where we go from dovish to hawkish and deal with different types of inflation issues. And I'm trying to find this graph. I usually have it on my screen here. Here it is. Not only will this it's going to take a minute, right? I think a lot of folks figure, okay, they've been tightening now. We've got all these rate hikes. How come inflation isn't coming down? Gang, it lags. And not only does it lag the rate hikes, it's really not the rate hikes at all. What I'm going to be watching is M2 money supply. Here's a look at how inflation, I love this title. I wish I created this graphic. I didn't. This is from the Bureau of Labor Statistics and the Federal Reserve, and I think this was in the Wall Street Journal to give everyone credit. I wish I created it. Beautiful squiggles. Inflation follows the money as the M2 money supply. As we slow down printing, I know, common sense, right? As we slow down the printing, that lagging effect is going to be that CPI is going to drop. So the M2 is in the blue line, the CPI is in that reddish line. As long as M2 continues to fall, the CPI lagging will, inflation number lagging will also fall. And we're in that very early part of that cycle. But remember, the market is always a forward-looking machine. So the folks that are getting in now, look at price, look at volume. The folks that are getting in now, they're not reacting to what we know at this moment. They're reacting to what they think is going to map out in the near future. We're always thinking ahead, right? So those are things I hope that are starting to click and make sense here. So thank you as always. Thank you as always. Now remember, what we're waiting to find out and what we're waiting for to see if there is going to be more bullishness, because gang, I don't know. Again, I'm not calling a bottom. I'm not calling a top. I'm not calling anything. All I'm saying is please don't short in the hole, right? Please don't presume lower lows and get reckless about where you're shorting because someone has said the markets are going to 3,000. It doesn't mean we can get reckless about where we're going to short. I'm going to tell you once again, find a price level, find a volume level and say, I'll dig my heels in at this setup where I can control risk. Until we see where the Federal Reserve is going to peak and plateau, and we get closer to that, it's going to be very difficult to say that the volatility is done, right? It's going to be very difficult to say that. So that's why the first step is, where do we end in December? And then where do we peak and plateau? And it looks like, as I was showing you on the chart, it's going to be around May of next year. Could be a little bit earlier. This data is always going to be fluctuating to inflation data and jobs data, but we're getting a better idea about where we're going to peak and plateau and when. And the more that stays steady, the more equity players will start to think about building positions to the long side. And this is the first time in quite some time that we've actually transitioned back into a neutral trend. This is still overall bearish, gang, but bearish doesn't mean we're looking for these, lows in the abyss. We're just remembering that the path of least resistance is still slightly to the downside. Okay, gang? All right. So in the meantime, is that even possible? Anything's possible. I've heard all sorts of numbers. I heard them back in April and May, and I'm hearing them again. The fact of the matter is, gang, we trade the now. And the now is where price and volume collide. All right, gang. I'll see you all tomorrow morning for Charts and Coffee. Thanks as always for joining us for our weekly report. I will talk with you all soon. Have those questions ready. We'll take a look at what this market looks like after we get the very, very early U.S. pre-market in tomorrow at 9 a.m. Eastern right here at the Simpler Trading YouTube channel. All right, gang. Be good to each other.